Hi, it's Nishi. Hope you had a really good day. So this video, I'm going to go over some common mistakes business owners make with their pensions. But before I do that, I want to remind you, we've got some really good resources at our website, n-accounting.co.uk, to help you grow and scale your own business and get your finances and taxes right. So definitely check that out. But back to this video. So common mistakes business owners make with their pensions. Well, one of the first ones is actually taking money out of their business and then paying into a private pension. Why is that a mistake? Because even when you pay into a private pension, although the government do give you your income tax back, what they're not doing is they are not giving your dividend tax back. So what would have happened is when you take money out of your business, you've paid corporation tax on it at that point, you paid dividend tax on it at that point. And then the government is then going to, when you put it into a private pension, they're going to give you your income tax, which is almost the equivalent rate of corporation tax, so the two cancel out, but they won't give you anything over and above that to compensate you for the dividend tax that you paid. So actually it doesn't work out to be a good deal. The best thing you can always do is put money into your pension via your limited company. So that's one common mistake I see people make. Another one is essentially people don't realize that actually if you don't use your full allowance for your pension in a particular year, it carries forward into another year. So at the moment, the allowance is about £60,000 a year. And let's say you don't have £60,000 spare in one particular year, but you might in the future. Then in an ideal world, you'd carry those pension allowances forward so you can put more money than the 60,000 in a future year because you've got previous year's worth of allowance that built up. But to do that, you've actually got to make sure that your business is on a scheme and then you're part of that scheme. Because if you're not part of your business's pension scheme, then you're not going to be able to carry those pension allowances forward and then use them in future years if you need them. So that's number two. And I think really number three, I was just going to go with, but actually I can think of a really good fourth one as well. So just bear with me. Number three is when people take their tax-free lump sum without realizing actually they can go on, that it restricts the amount of money they can put into their pension in the future. Obviously, there's loads of caveats to this and you've got to talk to a financial advisor and they'll give you a really good understanding of how it all works and all the exemptions. But in general, if you're at a point in your life and you want to continue contributing significant amounts of money into your pension, but actually you've just taken this large lump sum and then you've started the drawdown as well. So taking the lump sum on its own won't cause this issue. But if you started drawing down on one of your pensions, it restricts the amount you can actually put into your pension in the future. And that can be a challenge sometimes. So people sometimes unwittingly do that. And I guess the fourth one, I'm just going to look at it from a cash flow point of view, right? One of the mistakes is people put too much money into their pension and what happens is then they end up with issues within their business because once money's in their pension, it's very difficult to access without paying extortionate amounts of tax. So actually putting too much money in a pension and then leaving your business with cash flow issues is probably a really good fourth thing to point out and to avoid. So hopefully you found this video useful. And as I mentioned, check out our website. We've got some great content on there and I will see you soon.